If you have ever tried to find an international version of XLE, you have hit a wall. Two ETFs tried it. Both closed. So here is the closest thing that actually exists and why it is built the way it is. IXC is the iShares Global Energy ETF run by BlackRock. As of May 2026, it holds about $2.6 billion in assets across 66 energy stocks from around the world. Think of it as XLE with the international supermajors bolted on top. Inside the fund, you get the entire global energy club in one ticker. ExxonMobil at roughly 17%, Chevron at 10%, Shell at 7%, Total Energies, ConocoPhillips, BP, Enbridge, Canadian Natural Resources, Williams, and Schlumberger fill out the top 10. That is American supermajors, European supermajors, Canadian pipelines, and global oilfield services all in one fund. Here is how it works. IXC tracks the S&P Global 1900 Energy Index. Market cap weighted, large and mid-cap, no commodities or futures. Pure equity. If a company drills oil, refines it, ships it, or services the rigs, it is eligible. The fund rebalances quarterly and reconstitutes once a year. Now here is the catch. IXC is not really international. Roughly 55% of the fund is United States-listed companies. The other 45% is split across the United Kingdom, Canada, France, Norway, and a handful of other developed markets. So if you already own XLE and you buy IXC for diversification, you are buying the same supermajors twice. You are paying a 40 basis point fee on top of XLE's 9 basis point fee to add Shell, BP, and Total Energies into the mix. Why does this catch exist? Because pure ex-United States energy ETFs do not survive. SPDR tried with IPW. iShares tried with AXEN. Both closed for lack of demand. Retail investors who want energy exposure default to XLE. Investors who want international diversification default to broad ex-US funds. Nobody wants ex-US energy as a standalone slice. So BlackRock kept IXC as a global blend, and that is the only sector slice still standing. On performance, IXC has been a strong run this year. With Brent crude pushing above $110 and headlines about the Strait of Hormuz, IXC is up roughly 29% year-to-date through April. The fund yields about 2.5% in dividends, mostly because European supermajors pay heavier dividends than US ones. The expense ratio is 0.4%, which is high for a sector fund, but typical for anything with international tax handling. Who is IXC for? An investor who wants energy sector exposure beyond just American producers, who is comfortable with the heavy supermajor concentration, and who does not want to run a separate US sleeve and ex-US sleeve. It is a one-ticker solution for global energy. If you already hold XLE and you just want to add ex-US supermajors, you are double paying. If you do not hold anything else, IXC is the cleanest entry. One honest caveat: your top 5 holdings make up almost 45% of the fund. So when Exxon or Chevron sneezes, IXC catches a cold. This is not a hedge against the US energy sector. It is the US energy sector plus a European tilt. If this breakdown helped, drop a like and subscribe. In the comments, tell me whether you want a pure ex-US energy ETF that does not exist yet, or whether you are happy with the global blend IXC actually delivers.